Okay, so I should be on and running here, and you'll see that I kind of record just about everything that ever gets said all the time here. So now, this one was a new one. I picked up a, what was it, an email from John Maxwell, the leadership series type of thing. So I was reviewing some of the old emails there, and there was a quote in there from a fellow who was in his early 70s. And his analogy was, he says, life is like a roll of toilet paper. The closer that you get to the end, the faster it goes. So I thought, well, I bring that along. So I thought that was bang on. It made total sense. So it does relate to what I'm talking about here, too. So
we can all walk away with a piece.
Yeah, that's right. That's right. So a couple of years ago, I published my first book. It's called 7 Secrets Every Real Estate Investor Needs to Know. If you want your own copy, I've got one that I can give away today here. And I'd like to start with the very beginning of the book here. And this is bad when somebody reads from their own book to you, but it does deal with what we're talking about here today. So I'll get to the very first page that I wanted to discuss here. And this is the title of my next book, by the way, that's up on the screen here. So there is a reason why we're doing that. So I want to talk about why investing in real estate, but also to overcome some of the fears that people have in investing in real estate. So this is what I put in here. So why don't more Canadians invest in real estate? It really boils down usually to fear and lack of education. Most people believe that investing in real estate is risky. It very well could be. But this is the question I usually pose to people, especially somebody who's brand new. If your grandparents had purchased 2 more homes 30 or 40 years ago and simply held on to them, had them rented, would they and you have been better off? Absolutely. So what I did is I always use the analogy that probably the best one I had was a couple who worked for CP Rail, bought a brand new bungalow in Renfrew in 1958 and paid $8,100 and some odd dollars for it. And we sold it in 2008, so it was past the boom, but we still sold it for $408,000. So after 50 years, the growth, and is everybody going to see that again in Calgary or anywhere else in Canada? I'm not sure, but you never know. So anyways, what I'm leading into is the PowerPoint I have is divided into 3 different sections. And for most people, investing in real estate usually does suck. You see people come in and they're a landlord for a couple of years and they sell their property and they're on to the next one, or they're wondering what the heck can I do. So because I'm an investment realtor, I'm going to be focusing on, obviously, what I do, which is real estate. But I don't believe that everybody should be involved totally in real estate and should divide your portfolio up. So if you're a fund manager or somebody else that's promoting paper products and saying these are paper investments you should be getting into, I think by all means do that, or in your business. I just read an analysis that was done over the last 2 decades where they've interviewed consistently 5,000 deca millionaires in the United States and in Canada, and they had to have intergenerational wealth. So what they did is they took a look at the last 200 years with these families, and they had incomes in the 7 and 8 and 9-figure incomes on a per year basis, and they had the ability to pass on the wealth to the next generation who didn't squander it, and it kept on going. So they took a look at that very quickly, and they went through the analysis, but they took a look at what was their portfolio mix or the asset mix. And for their businesses, they invested anywhere from 32 to 38% of their investment in their own business, or they had a controlling interest in somebody else's business. About 30% was in paper, in other words, either some stocks or bonds, that type of thing, not really mutual funds and so on, or ETFs and so on, and the other third was in real estate. So I'm here to talk about the third, which is real estate, and we all have our own businesses and things outside of that we're investing in. So what I've come to realize, and especially being involved in RAIN and with a lot of other investment groups in Calgary and area, is that a lot of people get stuck. And I approached a couple of investment groups and I asked them, I said, in real estate investment, I said, what's the biggest challenge you have? And they said, it's absolutely to get people off the mark. You'll go to a weekend function and it'll be, 30,000 feet. This is all the stuff. You get a huge binder, you get a few DVDs or CDs and a bunch of papers, and you don't realize what to do at the end. So what I wanted to do was to drill down and get down to the sort of the nuts, guts, and bolts type of thing. And what do I need to do next to get me off the mark? It's nice to read a book and get things and get some education on that, but you really have to get started. So what I want to take a look at today is a couple, what I consider a bonus. One of them is going to be a GPS or a compass to know which direction the market is going, and as well kind of an economic framework, which Rain teaches anyways, as far as what to go for from the real estate investment side. And at the very end, that last page that I handed out is one of the things we're doing is rent to own and lease options and agreement for sale. These are a couple of profiles of two people that we're dealing with this week that we're looking for an investor to come in with, and these are some of the returns. So anyways, so we'll continue on here and we'll make sure that this thing goes. Here's my agenda, the pros and cons of real estate, that GPS that I talked about, the hybrid action plan, that's really a package of putting together the buy and hold with the rent to own. One home equals a lifetime of income, how that one rental property could provide a lifetime of income, and finally that investments there. So we'll take a quick look at the advantages of real estate investing. The one thing I like about it is it's simple. We're all involved in it. We're either living somewhere, renting somewhere, whatever. It's obviously, excuse me, prone to market conditions, can be good or bad. We're looking for populations where there are areas where there's population growth. Obviously, location is critical, and the cost of financing your investment. So I take a look at those things, and those attributes make for relatively minimal to low risk. So, and again, I'm doing this as a comparison to other products that are out there on the marketplace. So, okay, so you buy a piece of real estate. I'm going to really stick with residential today. I'm not going to be talking about commercial investments, although a lot of this will apply to that. What can you do? What's the upside where you can directly affect real estate, whereas if I buy some TELUS stock, I really can't direct TELUS on where it's going. So I want to have some control over that business that I have, and in this case, it's the business of real estate. Well, I can renovate it, and if that's for my personal use, fantastic. I can increase the value. I can tear it down and rebuild it. We're doing that in Altadore right now. We're knocking down, obviously, an old house and putting an infill in there, and then, you know, we've kind of got it marketed, going to be marketing at about $8.99. Okay, great. Or you can just turn around and sell it, or you can rent it on a long-term basis. Now, one of the things that I always encourage our investors to do is to use a manager, a property manager. Now, a lot of people will say, oh, go ahead and manage it yourself. Great, go ahead and manage it yourself if you want, just to learn the ropes. But after that, please hand it off to somebody else. Your time is much more valuable back in your own business, your career, or in looking at new properties and so on. The property manager, granted, they're getting 10% of the rental income usually, or 8 or 10 or 12, depending on where you're at. Let them go ahead and do that. You're making your money running your business and investing. The more experience that you have, the less time it'll take, and obviously you can continue your career by allowing the manager to take over what you're doing. There's really no steep learning curve. There's nobody that says that you can't invest if you're 18 or 88. It doesn't really matter. You can come in, and it doesn't matter what your background is. Really what we're looking for, though, is your desire to learn, put it into place with some experience, or team up with somebody that has experience. And success in 5 to 10 years, absolutely. And I think that how many of you have sold at least one home in the last 10 years? Okay, so if you've sold one home in the last 10 years, I'm hoping that you've realized some growth in the equity of it and mortgage pay down and so on. So in 5 to 10 years, could you do that? Absolutely. One thing that I do like, and I was listening to Warren Buffett, and he's so calm, cool, and collected. And there was an interview that was done in October of 2008, just after the world blew apart and the financial markets were in the pot and everything else was. Totally, you know, hey, this is great, you know what, we're going to get through this. You know, he didn't freak out. It was just, and of course he needed that for his investors, obviously, but it's just, you know, we're in it for the long haul, whether it's real estate, our own business, you know, that paper assets that I purchased. The get-rich-quick scheme probably doesn't work in any three of those asset classes there, although, sure, we read about it lots of the time, but, you know, that's a very minute part. You need relatively low capital to get started. Now, low capital to some people means $1,000 or $10,000, but I'm taking a look at it as in real estate, yeah, you can get started. In this case, I just use $40,000 to $80,000 where it's leveraged, you know, 4 or 5 times. So take those numbers and multiply them by 4 or 5 to figure out, okay, that's the type of property I could purchase. And the good thing is that the banks or the lenders look at your property as part of that collateral. So it's different than buying a stock where maybe you could leverage that to 50%, but here we can leverage it and get 5 times of our input. So what I wanted to do is take a look at, okay, gold is a hot topic right now. So I thought, well, let's take a look at gold and compare $20,000 of gold investment into real estate. So our investment value at the beginning is $20,000 for the gold, $100,000 for the real estate. And I went overboard and I said, well, what if the gold went up 50%, okay, in 3 years? And then real estate went up 10%. What's my new value? Well, and then I had 30,000 versus 120,000 with returns of 10 and 20. So even though some people say that, oh, real estate only grew that 10% in the 3 years and gold went up 50%, well, it still drops down to what did I realize at the very bottom line. Now, I'm not saying don't buy gold, because that's one of the things I purchase as well. But I'm just saying is you can't compare apples to oranges. There's different reasons why you buy different products. So long term, what I took a look at is the Canadian market over about the last 100, 120 years. And if you're in the mortgage business, you've seen all these numbers before. But we know the appreciation chugs along around 4 or 5%. It's usually, the value of properties usually is greater than inflation. There's very rarely that it's less than that, because it's tied to the cost of living.
Can you go back a slide?
Yeah.
I'm missing the math on new value.
Oh, sorry. The property rose. Sorry, it should be 110,000. Yeah, caught me. So it's the same value, but it's based on the, good thing you caught that for me. Same value based on the 10% versus the 50%. So real estate really been on the rise for the last 80 years. However, if you trend back 120 years, obviously, yeah, we had to go through the Great Depression. Increasing population is usually what increases the demand for real estate. Why do people look at real estate? Well, one of the things that we're taking a look at as you're starting to sell, as some of you are starting to sell some of your investment properties or have in the past, is your capital gain is taxed at 50% of the value of the increase. Hopefully it wasn't a decrease, so we're having an increase. There's no capital gains on your principal residence, so as we move from one property to another and we realize some growth there, we've got that. We've got advantages of our home-based businesses, obviously, and again, we can run our real estate business as a home-based business. And then if we do have our principal residence and we purchased a duplex or we're renting some type of our property out, obviously that becomes another part of our write-offs. What other things can we do? Well, our repairs, maintenance, and professional fees that are tied to that are part of that. Depreciation with CRA, mortgage interest, insurance, and so on. So we have a large pool of expenses that we can write off. High returns, there's capital appreciation over time. Again, what we're talking about is not an anomaly like 2006 and 2007 where we see 40% growth in Calgary. You have a debt reduction as you pay off your mortgage, and obviously you have some positive cash flow. And if you're not buying for positive cash flow at any time, and I know there's some people that come into town and do a weekend seminar, and they say, oh, don't worry about it if you're, it's negative cash flow, $100 or $200 or $300 a month. Well, you can only get so many of those things, and it's going to be pretty doggone negative. So start with positive cash flow. Rarely do you benefit from that property where you've got it so heavily leveraged, and we're still seeing that today. I'm really surprised at that. A lot of people are getting second mortgages or third mortgages, so that they've got such a little skinny amount into the property. You might as well go ahead, and if you don't have enough to put down to keep the leverage less or the loan to value less, get a partner or somebody else rather than trying to go in so skinny. And ultimately, the tenants will pay the mortgage on your behalf through rent. So who's our prime client or what's our prime asset really isn't the property itself. It's the tenant we put in there, whether it's a commercial business or whether it's a family and so on. So there's the financing side. Lenders favor real estate. If we take a look at the risk pyramid, the single-family homes are at the bottom, and then it works us all the way up to the top, which is land as far as the highest risk. So you can lend 80 or 90%. History shows it's stable. Long-term investments keep your spending in control. So what I did is I took a look at what was back in 1940, the value of a home, all the way up to 2009 as far as, again, an average value across Canada. Now, again, averages mean nothing to me because it's like the average temperature. If somebody said the average temperature today in Canada is whatever, plus 11, Celsius. Well, it doesn't mean anything because I'm not looking for somewhere else where it's plus 33 and somewhere else where it's minus 15 type of thing. So when you see something in the news, and this is the one thing that I disagree with even on the Calgary market, is there's really no average price in Calgary for a home. I can't go to particular neighborhoods and find that average property there, very, very rarely. So you've got to be careful with averages. So things to consider when investing. It's not a get-rich-quick scheme. Same thing, same principle usually in your business, and in often cases in your stocks or your bonds. There's a longer holding period. Every piece of real estate is different, so even though there's similarities on that same block with residential properties or possibly even on the retail plazas and so on, or apartment buildings, they're still different, either because of the structure or the income they generate. But there are some different guidelines. One of the things we take a look at is when we're looking at properties, especially, and I'm going to backtrack a little bit to beginning investors, we find that, and there's no reason why they shouldn't do this, but we get very emotional because if you're going to commit $50,000 or $100,000 to a property, you're probably going to get emotional, even though you want to drill down to the numbers. What I encourage everybody to do is if you're spending more than 15 minutes at that particular property, then you're spending way too long at that property as an investment, because you should be looking at the numbers, taking a look, okay, can I repair this thing? If it's got a weird floor plan, it's got a weird floor plan, it's not going to work. In 15 minutes, you should be in and out and kind of decide, okay, I'm going to shortlist, I can come back to this thing. So that's part of my action plan on what to do. And be logical. And that's why we have Dr. Spock. Okay, so what about investing, though? The selling process does take longer. Right now, if you take a look in Calgary, we've got almost 4 months for some of the things to sell. Some of them take less, some of them take longer. Right now,